There you go, just seconds before 4 p.m. on the East Coast. You're hearing the sounds of the closing bell there on the New York Stock Exchange. At this moment, it's 4 p.m. straight up, and after a rough start to the day, the Dow Jones ended up relatively flat, up only a fraction. You see, maybe 34 points.
That's right. The S&P 500 and NASDAQ also saw similar movement. So for more on this, we're joined now by JD Durkin. He is the host of TheStreet, and he joins us from the floor of the New York Stock Exchange. Hi there, JD. So walk us through, how did the market respond to the jobs report?
Well, it's great to be with you both here once again, and certainly a happy Friday. I mean, it's amazing. This is really indicative of investors really having kind of short-term memory, because there was a late day rally, which you oftentimes see in the last hour, 30 minutes or so of a trading Friday. But this morning, there was a lot of red on the big board here, my friends, and that was true in the hour after 8:30 before opening bell opened. And that was mostly true throughout the day across the major market indexes. That was the true story of the tail of the tape for the S&P, for the NASDAQ, and for the Dow. And that is because of this huge jobs report that we got today, where under any other normal circumstances, this is outstanding economic data in terms of wages, in terms of job growth, in terms of the unemployment rate. But since we are operating in the bizarro world of the American economy in 2022, where up is down, good is bad, that's actually an indication to investors that the Federal Reserve, or the central bank, will have to continue to be very aggressive in its ongoing rate hiking campaign, because of that good economic data. So traditionally, this is the sort of stuff you would see a White House or an incumbent political party celebrate. Not so much today, perhaps.
And the reason you're focusing on that is because earlier this week, the chairman of the Federal Reserve, Jerome Powell, said that there was a path for a soft landing, bringing down inflation without causing a recession. However, when you see these strong job numbers, you wonder if that soft landing will be further out. What is your view? How likely do you think a recession would be, knowing that job numbers are still strong and the Fed is trying to lean on that?
Earl, it's amazing to me whenever Fed Chair Jay Powell speaks. To me, it's always kind of a Rorschach test. If you're looking for him to be a bit more dovish in his comments, he'll give you things to make you think that's where he's leaning. And the same is true for the Hawks here. But, listen, he's given indications at times we'll have a soft landing, perhaps. He's also given indications it might be a bit more aggressive than that. But when you talk to, either you hear comments from, economists or the top CEOs across American capitalism, they're pretty much unanimous when they say if we're not already in a recession, we will be within the first 6 months of 2023. We've heard those comments from Jamie Dimon, from Carl Icahn, from Elon Musk. Even Jeff Bezos at Amazon this week told people openly, if you've got big purchases like that dream flat screen TV you've always wanted, now might be the time to start to tighten your belt because of how difficult the recession will be. So it remains to be seen when we actually get there, if we do. But it's pretty indicative, I think, to have all these major titans and power players of capitalism tell us we're likely heading there if we're not there already.
JD, what could realistically make the Federal Reserve rethink potentially slowing interest rate hikes?
I mean, that's a great question. There's a lot more economic data that comes out in terms of stocks and major equities. We always follow the so-called Santa Claus rally that could happen. But, the Fed has been pretty clear to say the so-called terminal rate, or the end rate when they're done with this rate hike aggressive campaign, is going to be higher than we previously thought. And it also says that they're going to keep rates at that elevated level for longer than we thought. And that's a very real impact. And for perspective for your viewers at home, in terms of what this means for you watching, more than 50% of Americans have a credit card debt. So if you carry credit card balance from 1 month to the other, because the federal funds rate has now been elevated so much and will go up, other borrowing costs are also going up as well. So if you have a credit card balance month to month, it likely means you will be paying more money on that interest than you would otherwise. It also means, Elaine, you're likely going to be paying off that credit card balance for a longer period of time than you previously thought. So I always want to make sure we go through the wonky, complicated nuances of the economy. We always try and break it down in terms of what this actually means to the average American watcher at home.
News you can use. And considering what JD just laid out, do your best to pay off those balances each and every month so you don't have to worry about those ever-increasing interest rates.
Absolutely. Good advice. Yep.
JD Durkin, always great to chat with you. Enjoy your weekend.
You as well. Thank you both.